What's up, everybody? Michael Silva here. The S&P 500 is pulling into a massive area of confluence, making me question here whether or not we're going to be seeing a bounce in the very near future. That's what we're going to talk about in today's stock market brief show. Kind of hopping right into it, we're going to talk about multiple aspects from a technical and intermarket standpoint. We're going to start with in the news. In the news today, consumer confidence was waning. The index fell to a 4-month low in September. That was according to the conference board. And this decline was attributed to rising prices, particularly in commodities like groceries and gasoline. And we have some political turmoil surrounding the potential government shutdown. This sparked concerns over the potential U.S. credit downgrade, with Moody's warning that a shutdown would be negative. Credit negative for the U.S. We had big tech companies like Google, Microsoft, Apple feeling the pinch with their stock prices experiencing a decline as rates continue to press higher. Now, adding to all of that, Amazon is facing legal charges. You can see here they're sued by FTC in 17 states over allegations it inflates online prices and overcharges their sellers. So we have the looming government shutdown, weakening labor market, and rising interest rates, all contributing to heightened risk of a potential recession. We also have Goldman Sachs estimating 2 percentage point drag on year-over-year quarterly GDP for each week the shutdown lasts. Let's hop into the market snapshot today, see how we perform. Now you're going to see over here is the daily, the week to date, month to date, year to date. I'm just going to focus here on the week to date because we're just 2 days in. And just notice the green bars on the screen. What you'll notice here is this one and this one. That's the 10-year yield and the dollar. And when the 10-year yield is up, it typically benefits oil, which I'll show you here later. And you can see one of the other ones that are basically flat was biotech there as well, and energy stocks. No surprise there, as the 10-year yield goes up, as oil goes up, typically benefits energy sector as well. If we take a look at the 11 sectors that make up the S&P 500 today, everything was in the red. It was a very strong move to the downside, a 2 sigma move actually in the S&P 500. We'll update you on those daily expected moves. If we take a look at new 52-week lows and then new 52-week highs, we have a total of 50 right here from our scanner there on FinViz, but we had 663 new lows, and I'm just pulling them from market cap highest to lowest. And we got names like Pfizer, NextEra Energy, UPS, American Tower Corp, Target, Estee Lauder, Hershey's, some big popular names continuing to get hit more to the downside. As the saying goes, weak stocks get weaker, strong stocks typically get stronger. At some point, they'll probably offer up some really good opportunities for a bounce trade. Some of these names have been just absolutely crushed. Going into tomorrow's trading session, we have durable goods that can obviously add a lot of volatility to the market. That's an hour before the market opens up. After that, we have that GDP. That's on Thursday. And then Friday, we have core PCE, personal spending, and personal income. All right, let's hop into some intermarket aspects. What's going on here? Take a look at the daily zones. The daily zones are using a indicator. Think of them as just more enhanced Bollinger Bands. They react and respond a little bit quicker, but it really gives a good fractal view of the market. And what I do is I extract bulk data from it and allows me to see what aspects of the market are going to the low end, to the high end of their respected bands. And if I take a look at the S&P 500, we are nearing the low end. We're about 0.5% to the low end. And these change, by the way, they are dynamic. They're constantly changing. And as the S&P 500 reaches its low, it's no surprise to see volatility index reaching near its highs. Similarly to that, if you take a look at TNX, it's the 10-year yield as it's reaching up to its high point over here of the bands. What do you notice down here? The TLT is reaching near its low. You can see that also with HYG. We've been talking a lot about the dollar and its correlation to the S&P 500. So when the S&P 500 is down here, the dollar's down or up over here. So as you can see, there are aspects getting to extremes of their respective band levels there. If we take a look at the dollar, just the chart from an absolute standpoint, you can see this thing is still on a monster move, reaching up to 106.2. We talked about this in greater detail on a prior episode, looking at a larger time frame. But as you can see, as this has been heading up, the S&P 500 has been heading down. The 10-year yield we previously discussed, but this thing has been on a monster move, breaking out to another multi-year high. One thing that I want to call out here is when you take a look at the yield curve, for this example, you can take a look at the 10-year, 2-year, and this zero line means that the yield curve inverts. And most people know that when the yield curve inverts, it's not a good sign, and it typically represents that a potential recession could be a year out or so. And you can see we came and inverted roughly around July of 2022, and since then we've been inverted. We've gotten inverted almost 110 basis points over here. And what you'll notice here is when it inverts and it goes deeper into that inversion from the zero marker, the S&P 500 typically rallies. You can see when it starts going up, you can see the yield curve going down. When the yield curve is going deeper into inversion, the S&P 500 rallied. And then what you're noticing here is, well, we're starting to uninvert. And if we start to uninvert, we're still pretty far off. But take a look how the S&P 500 is kind of rolling itself over as it stands. And one chart that really represents this from a massive scale is you look at the 10-year, 2-year down here. When it's in red, it's inverted. We're red here. We were red here for a brief moment. And then you'll notice down here is the Fed funds rate. And this is typically during hiking cycles, we get those inversions. And then something potentially breaks where they have to flush rates back down, and so forth. And it's interesting here is when it uninverts and when the rates start going down is typically when we have that weakness in the overall stock market. So as this has been going up, we're getting a little bit of weakness right up in here, but you can still see, the narrative here is rates higher for longer, unless something changes. But then also if we start uninverting, what the Fed is going to do to potentially resolve some massive market volatility that, if it continues, can create some havoc, obviously. If we take a look at the oil WTIC, we have pulled into that area of resistance, and we've been just consolidating there. You can see kind of just flagging sideways as it stands with that negative divergence on the price percent oscillator. You can see prior resistance. This resistance was once support. So if we break above this, careful, because we can potentially consolidate, pull back, act as support, and head even higher. And that's not a great sign for the market. And I'll tell you why. This was September 12th when I posted this out on Twitter, and I made a video too the same day about it. But this is when energy sector shows leadership. It's not typically a good sign for stocks. And you can see here, this was XLE SPX ratio. When this goes up, it means energy sector is showing leadership. And while this was going up, what was the S&P 500 doing? Well, it was showing volatility to downside. And when this was going up, what was the S&P 500 doing? It was going down. Well, let's get an updated chart here. It continued to go up. And what happened? Well, we broke down pretty severely there in the S&P 500. So it's not healthy seeing energy really being the main leader overall. I want to show copper here. This is an interesting divergence taking place. We've been seeing some weakness here, and the chart looks rather weak. Honestly, it looks like it could potentially break down further, retest these lows. But you can see S&P 500 actually already cracked a prior low. You can see a low and a lower low, where right now we're actually putting in matching lows. So this divergence, it could break very easily, but I'm pointing it out because it's there right now. And you can see in the past, for example, finding this October bottom, S&P 500 put in a pretty severe low over here, right? But what it was copper doing, it was putting in a higher low, and that really led to that market rally. The same thing took place right here. We saw it multiple times right here as well, and it's kind of forming, but it's on the verge of potentially, obviously, divergence potentially breaking and not even mattering. I just wanted to point that out, though. Let's take a look at the S&P 500 and why we think there can be a potential bounce here in the markets. So first and foremost, we'll take a look at some key levels. So I'll look at the anchored VWAP from this prior swing low out in March. Price is pulling into it. We have a gap level right over here, and that gap level is matched in with a gamma exposure level at around 424. So gaps, they can act as potential support, right? Once the windows close, they can potentially bounce. We have the year-to-date anchored VWAP down here too as well. Now there's obviously a big spread between 420 and where we are now, 425, but this zone is offering up potential a lot of confluence to see a bounce in the very near future, as it's already pulling into a potential area of supports. Now, if I take a look at the 15-minute chart, I'll update you on some new levels. Okay, so the daily expected move, right? We had a 2 sigma today, so it actually reached 2 sigmas out here and closed basically on it. But the new 2 sigma level move is down here at 418.75. And then we have the lower daily in confluence with the lower weekly expected move, which is about 422, just around there to 422.31 is the lower daily. If you want to see these charts blown up a little bit more, I'll post the chart deck on my Twitter. Okay, the upper daily expected move is 429.45. And I'll show you, the possibility for a bounce here in another 15-minute chart momentarily where I bring in the RSI divergence. But overall, when I'm looking at this, obviously the trend is still down, right? You have a declining 5-day moving average. So, any long take that you take has to be tactical. We talked about the potential breakout of this trend right here. I couldn't make a video last night, but we broke above it. We said on Twitter, if it gets below this swing low, that would be this ideal stop. Or if you wanted to give it more room right here, and when we broke that, boom, it came back, acted as prior support, acted as prior resistance, and we started selling off more. So that's why it's very important to continue to manage risk in a bearish trend. If you want to see a bullish trend, you want this flattening out, you want price to get back above it, then you want to start to see it turn up, and you could be a little bit more confident that the trend could be changing and we could see some further upside. Now, I want to bring you to the daily time frame and show you also some more areas of confluence. So we talked about this anchored VWAP coming up and being right around this level, but we're also pulling into a prior low of a channel. So this is active support, draw the trend line out, have these parallels go up, and we're right about that level. So just a little bit lower on the SPX, we could very well potentially test this prior support and see if that support holds. It's also measuring out a bear flag or bearish pennant type pattern, and a full measured move would also bring us into that lower level of the channel. But that's not all. There's also more levels of confluence. So if I go in and layer it up, as price is pulling back down, it's retesting this prior swing high, this prior swing high as well. So these prior resistance can act as potential support. Okay. Also, you'll notice a kind of a multi-gray shaded area in here that's showing the gap level, and then also the weekly expected move for the SPX is at 42.36. So if we pull back a little bit more, there's also the 200-day moving average, right? There's a lot of confluence up in this area to potentially say, hey, it was a very strong move. After strong moves, you don't really want to short into a strong move because you could get a snapback rally, could go up, and then boom, we could try to retest it, or you see some sort of dead cat bounce as people cover into areas of prior resistance, which obviously can be prior levels of support. So gap fill, prior areas of resistance. We have the 200-day lower channel measured move. All right, we talked about also the aspects from the zone sheet here as they're reaching the lower ends. It's not the typical area where you'd want to short into it, but this is all taking place on a dollar that's honestly ripping, and the 10-year yield that is ripping there too as well. So we obviously have to manage risk and be cautious. Now, I told you I'd relook at a 15-minute chart. As price has been getting down a little bit, I still think that, hey, if it doesn't bounce, it's okay, but there is a positive divergence building. Price has expanded to the downside, and it's contracting rather tightly. When I take a look at a couple of indicators, a couple other indicators are telling me that we're getting a little frothy here too to the downside. Now, we can have, things that typically crash from these levels, so we need to obviously manage risk as we see. But one thing that I'm noticing is over here is the NASDAQ 100. It says 9 is the reading here as it's getting below this level. What does that mean? It means that 9% of the stocks, only 9% of the stocks, right, of the NASDAQ 100 are above their respective 20-day moving averages. Only 10% of stocks in the S&P 500 are above theirs. Or another way to say this is 90% of the stocks, give or take a few points there, 90% of the stocks are below their 20-day moving averages. And I can show you a chart here. The last time that the NASDAQ 100 had this low of a reading was actually going into 2023, where we saw a rally. But be mindful, because these things have gotten lower. Like, for example, in October, it was down there at around 0% of the stocks were above their 200-day moving averages. We're also here coming into around the end of month, end of quarter. September, like I said, prior, right? Starts off weak, ends typically weaker. That's what we have seen. Towards the end of this month, it typically looks like we can get a potential bounce or kind of go sideways. So there's a lot of opportunities here and areas of confluence to potentially trade into. Hope those levels are going to help you out in tomorrow's trading day. Please be careful, because we have some intermarket aspects that are obviously throwing, just flashing red signals. So you need to be very mindful of that and be very patient executing your trades. That's all I got for you. See you later.